In this video, I want to talk about economic indicators, what they are and how they impact stock market performance, how economic indicators impact stock market performance. So I want to discuss, this topic under a number of important subheadings. So I start with number one, introduction to economic indicators. Introduction to economic indicators. Economic indicators are statistical data points that provides insight into the overall health and direction of the market. These are statistical statistical data points or figures or numbers that gives an insight into the overall health and direction of the economy. And so economic indicators are essential tools for investors, for analysts, and as well as policy makers to predict economic trends and stock market performance. So if you are very conversant with these indicators, it will help you to predict to a larger extent of accuracy the direction of the markets and the performance expectation from the markets. Number two is the types of economic indicators. Types of economic indicators. We have leading indicators. So leading indicators comprises stock price index, stock market indexes, and consumer confidence index. And so we equally consider. Let's look at stock market indexes. So these indexes actually they often lead the economy. As stock prices reflect investor sentiments about future growth. Generally, stock price, will then reflect, investor confidence sentiments about, future growth of the economy. So you have, a consumer confidence index. Apart from the stock market indexes, you have a consumer confidence index. This reflects consumer optimism or pessimism, and that will go a long way to impact, spending habits, consumer spending habits. You also have what is called building permits and housing statistics, building permits and housing, statistics. And so this predicts, future construction activity, signaling economic expansion or contraction. The more people build, or the more people, obtain permission to build, it signals the fact that the economy is rebounding. The economy is doing well or about to do well, because construction generally signifies increased construction signifies a booming economy. Then you have the lagging indicators. I've just discussed leading indicators. I want to also discuss and talk about lagging indicators. Lagging indicators incorporates unemployment rates. Unemployment rate is a significant lagging indicator. So in this case, it reflects past economic performance, and but can confirm trends in recovery or recession. In an atmosphere of low unemployment rate, it indicates that the economy is not doing very well. You equally have corporate profits. So changes in profit level can confirm shifts in the economic cycle. Generally, when corporate profits starts to rebound, it means that the economy is doing very well. And when corporate profits is lagging, is declining, it shows the economy is not performing very well. There's interest rates. Changes in interest rates set by central banks often follow economic trends and affect borrowing and investment. So whenever there's that regular changes in interest rate, it shows that the economy, is not doing as well as expected. So the government is intervening to be able to boost consumer spending by cutting interest rates. Not only that, you have what is called the coincidence indicators. coincident indicators. So these are indicators like gross domestic product, the GDP. So it measures the overall economic, output, the output in goods and services, in the economy, directly correlating with, stock market performance. Generally, the higher the GDP, the better the performance of the stock markets. You also have on retail sales. In an atmosphere of increased retail sales, it indicates that there's consumer confidence and there's discretionary income, to boost, retail sales, to boost, consumer consumption. Not only that, there's industrial production. A heightened level of industrial production indicates that the market is, the economy is doing very well. The economy is performing fine, because generally, in an atmosphere of, economic, upturn, you discover that there will be increased level of industrial production. Not only that, number three, high economic indicators affecting, how economic indicators affects stock market performance. How do economic indicators affect stock market performance? So in this case, there's what they call the positive data. You have positive data. So you're talking about, higher consumer confidence and spending. These are some higher consumer confidence and spending. Whenever there's, consumers have confidence that the economy will do very well, they tend to spend the more. They spend more. So you equally have, strong GDP growth. In an atmosphere of strong GDP growth, it means that the economy is recovering or the economy is doing very well. It's a positive signal that the economy is, is at the peak or at the booming, phase. So you have the negative, data. We've considered positive data, which incorporates consumer, spending as well as strong GDP growth. We also want to look at negative data. Negative data actually has to do with rising inflation as well as weak GDP, or declining industrial production. So in the case of rising inflation, inflation can hurt the purchasing powers of consumers generally, and that would typically affect sentiments in the markets. And not only that, we equally look at we equally consider we consider high interest rate. Higher interest rate will certainly hurt the economy because that would restrict lending, and once consumers cannot really access funds at a cheaper rate, that will curtail their level of spending, and a lower level of spending will affect the stock markets, affect the economy tremendously. In the case of a weakened GDP or declining industrial production, it indicates that the economy is on a slowdown, and that will lead to a bearish sentiment in the markets. Please like this video and subscribe to this channel if you've not done that. Number 4 is the importance of combining indicators. The importance of combining, these indicators. So using a single indicator may provide incomplete or misleading insights into how the economy is performing, to how the market could react. So combining leading, lagging, and coincidence indicators, allows investors to assess economic, trends more accurately. So you combine all these indicators, the lagging indicators, the leading ones, and the coincidence ones I've just explained earlier. When you combine them together, to give you, a better premises to be able to predict the market and the economy accurately. Number 5 is, case studies we need to consider. So in this case, we look at what happened, during the global crisis. We had, rising unemployment and a contracting, GDP, which led to, stock market crash. In the case of COVID, the COVID-19 pandemic is also a study you must consider. Actually, We saw how low interest rate and government stimulus spending helped the economy to rebound during the COVID crisis, despite the decline in overall GDP. So that's important case studies that we could analyze this particular topic with. And number 6 is how investors can use economic indicators. In this case, you could predict the market trend by using economic indicators. You could as well, incorporate sector rotation. Look at the sector that will benefit from the economic cycle and invest in those sectors, and avoid sectors that may not benefit from a particular economic cycle. So this is very, very important. And so in conclusion, it's important, the importance of understanding economic indicators in shaping stock markets is cannot be overemphasized. And so we should be able to know these indicators and be conversant with them and know how to apply them when it comes to our investment decision making. How to be able to utilize these indicators to predict, the economic cycle, as well as stock market performance, and see how we can tally this particular knowledge to our investment decisions.